Most people think the stock market is where smart people make money and unlucky people lose it. But here's the uncomfortable truth. Most people who lose money in stocks aren't dumb. They're not reckless, and they're not doing anything crazy. They're doing what feels normal, what sounds reasonable, and what everyone around them is doing. And that's exactly why it goes wrong. Today, I want to talk about why most people actually lose money in stocks, even though the market goes up over time. And more importantly, how to avoid the same traps without becoming a finance nerd or staring at charts all day. If you've ever felt nervous investing or confused why your returns don't match what you hear online, well, this video is for you. Now, let's start with the biggest one. Most people buy stocks emotionally, not logically. Most people don't invest when things feel boring and calm. They invest when things feel exciting. So think about how people usually get into stocks. You could have a friend bring it up, a headline that pops up, or everyone at work is suddenly talking about the same company. You open your app and see a chart going straight up, and your brain says, okay, I don't want to miss this. That's not strategy. That's pure emotion. The problem is, by the time something feels obvious and exciting, a lot of the gains are already gone. So people buy near the very top. Then the market does what it always does. It pulls back. And now the exciting thing turns into anxiety. And anxiety leads to bad decisions. Either it be selling too early, or panic selling at the worst time, or swearing off stocks altogether. So this isn't a discipline problem. It's a human-based problem. Our brains are wired to chase what's working right now and avoid pain right now, even if that hurts us long term. So here's what to do instead. Decide how you'll invest when you're calm, not when the market is loud. If you wait until you feel confident, you'll always be late. People think investing is about being right. A lot of people approach stocks like a test. They want to pick the right company, time the right moment, or sell at the right peak. And when it doesn't work out, they assume they're bad at investing. But investing isn't always about being right. It's about being consistent. And here's a simple reality check that most people ignore. Even professional investors are wrong a lot in this space. They just survive their mistakes long enough for the winners to matter. But regular investors, they tend to go all in on a few ideas. And they tie their identity to their picks. And then they bail the moment something goes wrong against them. And that's how small losses turn into permanent ones. So here's what you do instead. Stop trying to outsmart the market. You don't need to pick perfect picks. You need a system that works even when you're wrong. Think broad diversification, longer time horizons, and the humility to accept that you won't nail every single decision. Most people sell at exactly the wrong time. This one hurts because almost everyone has done it. Markets fall, your account balance drops, and every headline turns negative. And suddenly, holding feels irresponsible. So people sell until things calm down. But here's the problem. By the time things feel safe again, prices are usually higher, so people sell low, they wait, and buy back at higher prices. Ultimately, they don't lose money because the market is broken, they lose money because their timing is backwards. And let me put it simply, the stock market transfers money from the impatient to the patient. And patience doesn't mean doing nothing forever either. It means understanding that volatility is the price of long-term returns. So here's what you do instead. Expect downturns before they even happen. If you assume the market will drop 20 or 30% at some point in the future, because it will, then when it happens, it feels normal, not catastrophic. You don't panic over what you planned for. People underestimate how long-term actually is. A lot of people say they're long-term investors, but emotionally, they're thinking very short-term. They invest money they might need in a few years. They watch their accounts daily. They judge successes based off of months, not decades. Then, when life happens, either it be a job change, a move, and an unexpected expense, they're forced to sell at a bad time. And that's not bad luck, guys. That's misalignment. And yes, stocks are powerful because of time. Take away time, and you take away the advantage. So here's what you do instead. Only invest money you truly won't need for a long time. If your timeline is short, your investment should be boring and stable. But if your timeline is long, then volatility actually becomes your friend. Match the investment to your goal, not the other way around. This one is subtle. They confuse activity with progress. People feel like they need to do something, rebalance constantly, or switch strategies, or jump into whatever worked last year. It feels productive, and it feels smart, but most of the time, it just creates taxes, fees, emotional exhaustion, everything else. Some of the best performing portfolios are owned by people who barely touch them at all. Not because they're smarter, but because they're less involved. So here's what to do instead. Create a simple plan that doesn't require constant decisions. The fewer choices you have to make, the fewer mistakes you'll make under stress. And boring is powerful, and I mean it. So here's the big takeaway. Most people don't lose money in stocks because the market is unfair. They lose money because they invest with emotions, short timelines, and unrealistic expectations. And the market rewards patience, humility, and consistency, even if it doesn't feel exciting. And the good news? You don't need to predict the future. You don't need inside knowledge. You don't need to beat anyone else. You just need to avoid the obvious traps. And if you like this video, you might also enjoy the others in this series where we talk about spending, investing, and building wealth without stress or hype. Thanks for watching, and I'll see you in the next one.